Okay. Hi everyone, this is the seventh lecture of Monetary and Financial Economics B2. Today we will continue our discussion related to international monetary systems. So this is the last part of international monetary systems. So we will cover these three contents: transformation and crisis in the world economy, what has been learned since 1973, are fixed exchange rates even an option for most countries? So the first topic is transformation and crisis in the world economy. So let's check the crisis in Europe and Asia. So 1989, the Bretton Wall fall, the fall of the Bretton Wall, sorry, Berlin Wall, sorry, the fall of the Berlin Wall. July 1st, 1990, the West and East Germany unified. The unification of West and East Germany. The European countries were pegging their interest rate to the Deutsche Mark. So European countries, the most of European countries are fixed exchange rate. So they fixed with Deutsche Mark. So then there is an inflationary pressures in Germany. So Germany, to avoid this inflation, Germany conduct contractionary monetary policy. But other European countries faced slower growth because they were not afflicted by rising inflation as Germany was. So other European countries faced relatively low inflation rate compared to Germany. So therefore, European countries faced slower growth because of Germany's contractionary monetary policy. Then European countries faced a massive speculative attack in 1992. In Japan, there is inflation loss as a partial result of a relatively loose monetary policy from 1986 to 1988. So to avoid yen appreciation after the sharp post-Plaza Accord rise, so this monetary policy is to avoid yen appreciation after the sharp post-Plaza Accord rise. Then such low interest rate environment causes asset price bubbles. Then BOJ, Bank of Japan, tried to restrict the asset bubbles by restrictive monetary policy. Because of this high interest rate by BOJ, the Nikkei stock price index lost more than half its value between 1990 to 1992. The sharp fall in asset prices threw Japan's banking system into crisis and the economy into recession. So this is bubble hokai in Japanese. So deflation and deflation and stagnation lasted the following decade and a half. Even now, Japanese faces deflation and stagnation. Japanese is said to be in deflation and stagnation. But at these stage, prices go up, but so before COVID-19, Japanese faces deflation and stagnation. 1997 to 1998, Japan's slowdown in 1997 weakened the East Asian economies. So Japanese economy slowdown makes the East Asian countries weaken. So the East Asian economies had experienced rapid rates of GDP growth for many years through 1997. But many of them are fixed exchange rate against dollars. So then there is a speculative attacks. So beginning with Thailand baht in the spring of 1977. And so such speculative attack make the East Asian economies into recession. In 1998, Russia defaulted on its internal and external debts. So this causes worldwide depression. 1998, 1999, a series of interest rate cuts by FRB, Federal Reserve Bank, it's a central bank of the United States, and 11 European countries. So a series of interest rate cuts conducted by FRB and with 11 European countries to fight crisis. In the late 1990s, the US stock market soared as money flooded into high-tech dot-com stocks related to new internet-based technologies. So this is called the dot-com bubble. So investment loss and US current account deficits accumulated. In 2000, stock prices began to collapse. So this is the dot-com crash. So the US economy became into recession. So then during the recession, investment falls, but current account is still in deficit because of falling savings due to a rapid increase in the real estate prices. So Americans borrowed with low interest rate against their rising home equity values. So then the dollar began to depreciate. Because current account is derived by S savings minus I investment. So a low S saving means the current account deficit. So US current account deficit means that Americans' investment is greater than the supply of savings. American investment can be regarded as a demand for saving. So therefore, the US current account deficit means that a demand for savings is greater than supply of saving. So despite of current account deficit, the US real long-term interest rate fell. So why? It would seem more natural for real interest rate to have risen, encouraging US savings and discouraging investment. But in actually, despite of current account deficit, long-term interest rate fell. So this is contradict to the theory. So this graph shows global external imbalances during 1999 to 2016. So you can see that yellow bars are United States. And here is 0 bar. So this is 0. This level is 0. So you can see that US current is deficit during all periods. Yellow bars are below to 0.0 bar. And you can see that the surpluses countries are Japan, New Industrial Asia, and Central and Eastern Europe, and so on. So therefore, mainly Asian countries tend to accumulate the surpluses. Asian and European countries tend to accumulate surpluses, current account surpluses. In contrast, the US current account is deficit in all time. So over the 2000 current account surpluses of several countries outside the US rose. So over the 2000, here is 2000. The surpluses basically grow up. So especially before the global financial crisis around here, the surpluses grow at first. Why these countries tend to accumulate current account surpluses? So there is several reasons. First reason is Chinese economy's rapid growth. So the Chinese economy grows rapid pace. So it increases the price of primary commodities. Then such commodities, so the increased revenues of such commodities in exporting countries. So the exporting countries tends to get large current account surpluses. The second reason is that the lower willingness to invest in poor countries due to the crisis in the late 1990s. So in poor countries, there are lower willingness to invest because of the crisis in the late 1990s. So they accumulate the US dollar reserves to avoid the crisis. An increase in the supply of savings from the outside the US and decline in the investment demand causes a fall in global interest rate. Then, such low global interest rate increases housing investment in the US and European countries. So then house price appreciation and boom occur. So such boom is the seed for the global financial crisis. So such house price boom, housing investment boom is the seed for the global financial crisis. So this graph shows the long-term real interest rate for the United States, Australia, and Canada. So you can see that in all countries, the lower long-term real interest rate tends to be low and decreases. So therefore, such low long-term real interest rate causes housing investment booms. So let's move on to the next topic in the next video.